Welcome to Pure Conversation. This week's guest is mutual fund lawyer George Silfen.
You recording? All right. How did you get into mutual fund law?
Okay, because nobody just grows up and wants to be a mutual fund lawyer.
Yeah.
And my parents didn't even know what a mutual fund was. Until at some point. So the reason why I got into it is because the law firm that I ended up interning at during my summers at law school, the hallmark of that firm was mutual fund law. So I wanted to get into the best practice of that firm, which happened to be mutual fund law. And I also heard that was a good practice in terms of lifestyle, where it wasn't transactional and it was more practice that you would have more control of your life. So it stuck from that firm on, and since 1994, that's what I've been doing.
So we understand that your part of your specialty is not just standard mutual funds, but alternative mutual funds. So can you tell us maybe first a little bit, what's the difference, and maybe a little bit about your experience in alternative mutual funds?
Okay, so in my world, the opposite of a mutual fund is a hedge fund. But I use the term mutual fund as referring to something as the opposite of a hedge fund. Hedge fund is an unregulated fund in general. I mean, it's regulated, but nowhere near a mutual fund, meaning a hedge fund is not registered under the Investment Company Act of 1940. Mutual funds and other registered funds are. So my expertise was having a practice serving traditional mutual funds, which are regulated under the 1940 Act. But there are many hedge fund managers and private equity fund managers who want to explore and want to diversify their own product line and want to get into the registered fund space because they want to expand the distribution of their product. And because right now, hedge funds, are only sold to a limited amount of people, to very rich people in general. Mutual funds, registered funds can be sold to the public generally. And so some managers want to get greater footprint and therefore want to get into the registered fund space. So I help those managers develop registered product. And I felt that was an area of growth. And that's why I tried to get into that niche space.
Does that, so in the alternative fund, what type of assets are you normally talking about that are in that category?
I think it's more the manager.
Mm-hmm.
So if the manager is, quote, an alternative manager, meaning their products are hedge funds or private equity funds, then they have alternative product.
Okay.
If they're not a traditional mutual fund manager, they're an alternative manager. It doesn't necessarily mean that they have a hedging strategy per se. It doesn't mean that they have a liquid strategy per se, or that there's some exotic asset that they're investing in per se. It's just the fact that their market is a private, a private market, sold exclusively to wealthy investors or institutions.
And what would just be the difference? Meaning, why would someone go through that route as opposed to a more regulated route?
Because it's much less burdensome, costly to run a hedge fund than it is a mutual fund or registered fund. You have less regulations, you have less SEC exposure, fewer shareholders to deal with.
Got it.
Yeah.
So talking about alternative funds, now there's a lot of hype at the moment with cryptocurrencies. Do you have any funds that you deal with who are now using crypto, or are you very against it?
I'm not against it. I just don't have any clients that are employing those strategies.
And do you think that will change now with a lot of
I thought it
people
would
looking
change.
into it?
Like 2 years ago it was hot, and then
Mm-hmm.
it died. Now it's hot again, and I don't know. It might. Not sure.
Do you think that has to do more with the nature? Meaning, there's a lot of debate, and I see that, and I find some odd things in terms of like how that the government views cryptocurrency as almost like a commodity. So, do you think the nature of why funds aren't doing it is because of, you know, crypto? It's not exactly a currency. It's not exactly an asset. Are they avoiding it because of that issue, or do you think it's just, you know, not what the type of manager?
I think managers have their expertise, and if this isn't their expertise, that's not what they looking to manage. You know, managers that I deal with are debt managers, credit managers, global long short equity managers. They don't invest. This isn't their strategy, asset class that they at least not yet, that they've developed an expertise in.
Okay. And so what is the process of building a mutual fund? Like, it's some of the key steps.
Key step is, first, the most important thing is, and I tell clients who are think about doing a registered fund. Remember, mutual fund, by the way, they keep using the term mutual fund. Mutual fund is an open-end registered fund. You can have a closed-end registered fund. An open-end registered fund is one that you go in and out of. You can go in and out every day at the value of the portfolio.
Mm-hmm.
Closed-end fund, you can't go out every day. You could go in, but you can't go out every day by definition. That's what makes it closed-end. Some closed-end funds trade on stock exchanges, and that's how people get liquidity. Some closed-end funds, they do tender offers to give people some liquidity to come out, and they buy back shares at value to let people go out. So anyway, so in doing a registered fund, the first question that I ask any client is, how are you going to sell this fund? I'd love to do product, but I want to make sure you're going to tell me why do you think you're going to be able to raise $100 million, let's say, over the first year or so? Because I really think you need $100 million in order to at least break even to run one of these kinds of products. So they have to have a credible distribution plan. And even though it's got nothing to do with legal steps, I think it's important, and I want to be upfront with a client, a prospective client, to go over what it takes to make the fund financially successful, and to go over their distribution strategy. The legal steps involved, the most important first step is drafting and filing a prospectus or registration statement with the SEC. It sits at the SEC for a certain amount of time. The SEC comes back with comments. You have to organize an independent board. At the end of the day, the whole process to set up a registered fund is probably around, if things go relatively smoothly, I'd say somewhere between 4 and 5 months.
Mm-hmm. And then is there a difference between the open-end versus closed-end in terms of registry, or it probably closed-end, it's a little faster? Very. And then what are the usual type of questions you find in your practice? Are they more in terms of building mutual funds? Are they more in terms of things like, I don't know, issues about having, I don't know, maybe cannibalization between multiple funds? Like, what type of questions do you usually deal with?
The average day-to-day questions are running the business, running the strategy, disclosure. This is what I want to do. This is what I want to change. This is what we're trying to accomplish. You know, how can we do it? How do we change this? How do we disclose this? How do we want to, you know, it's managing the existing funds. New funds and new products, you know, they don't happen all the time. And then once you start the fund, you're dealing with more managing again. So helping clients manage the day-to-day of disclosure, dealing with investor questions, dealing with service provider questions, dealing with portfolio manager questions, dealing with helping the board get ready to satisfy its responsibilities.
Right. And then I had a follow-up question. There seems to be a lot of conflict. Meaning, if someone has multiple funds, a company or a manager, there seems to be like a lot of conflict that goes on with it. For example, let's just take, for example, like Vanguard. I don't know if you, but Vanguard has hundreds, maybe even thousands of funds, mutual ETFs, etc. So the question is, being that some funds that have one strategy and other funds have other strategies, isn't there sort of a conflict of interest where sometimes maybe one fund might leverage the fact that another,
you can have conflicts when you have multiple products, especially you could have conflicts if you have multiple products with the same strategy. You could have conflicts in multiple products with different strategies. You could have conflicts with the same strategy because, let's say, there's some opportunity available and there's a limited amount of it, and you, let's say, an IPO or something, and it's eligible to go into the two funds that you manage that have the same strategy. Which fund gets that IPO? Which fund gets that investment opportunity if it's suitable for both funds? And there are, so that has to be managed. And all credible managers have what's called an investment allocation policy, where they're required by law to allocate their opportunities fairly and equitably. They take into account cash available, tax requirements of the client, of the fund, of the fund's investors. They take into account risk tolerance. Some funds may look like they have a similar strategy, but they have a greater risk tolerance. So all these factors go into, and the most important thing is you have a policy. And if a particular acute conflict comes up, then you try to document. If you're accepting away from your normal policy of allocating pro rata, you have to document a rationale as to why you're doing so, in case somebody like the SEC comes and asks.
Got it. And then I guess a final question to wrap this up. Recently I saw an article that there are more funds than there are, things in the stock market. Suddenly there are more pure mutations of the market than there are in the market. Is there too much? Is the market too saturated? What do you think the future is this industry? It's exploding beyond anyone's wildest dream in the last 10
years. I think the consolidation is going to continue. You're going to see funds consolidate, many funds. There'll be fewer funds. We have too many mutual funds, but I don't think we have too many alternative registered funds, what I call public alternative funds, closed-end alternative funds. Those there aren't that many of, and I still think there's room for growth there. But I think when it comes to mutual funds, regular mutual funds, I think the market is saturated with product. And what's going to happen is whichever funds are the hot funds that have the greatest Morningstar rating this year and are the hot funds, those are the ones the assets will chase. And others, will lag.
All right, thank you very, very much, George, for your time. Really, really insightful information. So thank you for providing that to us and for our listeners. And I definitely have learned a lot, and I hope Joseph and the rest of our listeners will do. So thank you so much for joining us.
My pleasure. Thank you very much for having me.